VIX is the basically in the implied volatility of the S&P 500 futures. And it is a gauge of fear. I did some initial research on it before it was called the VIX in the early 1990s. It's very useful in terms of getting people's perception of risk in the market. However, and this is a big however, it is a very short-term indicator. So it measures fairly short-term volatility, and what we're really concerned about is not just short-term volatility, but the whole term structure of volatility. And that's more difficult to get at. So, for example, we've got something in our CFO survey that has been untapped. We asked CFOs, as I said, about the 10-year forecast for the S&P, and we also asked them for the 1-year forecast. So we've got kind of a term structure of forecasts. But then we also asked them for both of them. We ask what their, we say there's a 1 in 10 chance the 10-year return is going to be greater than X. There's a 1 in 10 chance it's going to be less than X. So for each person, we get kind of an 80% confidence interval. And that can be mapped directly. If you've got the forecast, you've got the confidence interval, you basically got that individual's view of the volatility. So we've got a measure of the term structure of volatility. And I think that's what the VIX is kind of lacking. The VIX also, so much is tied to it, and it's so volatile, so the volatility of volatility, that it's hard to say when the VIX goes to 80 that, well, what does that mean? Like, it doesn't mean the volatility is going to be 80 for the next 10 years. Question of how long, you don't get that information. It is definitely a good indicator of risk, but not the only one. So other indicators that you would look at would be some sort of credit spread, whether it's a traditional corporate bond credit spread or a euro-dollar short-term spread. And you can get some idea of the term structure volatility from that. Looking at credit of different maturities, that's a good indicator of swap spreads, things like that, and implied volatilities in different instruments. And one thing I like to do sometimes is to look at kind of the volatility skew. So you look at the implied vols of puts and calls equally, around the current market price, and that gives you an idea of kind of the sentiment of the market. So if people are really piling into the puts for protection, that's going to increase the implied vol of the puts. So there's a lot of things you can look at. VIX is kind of on the list. It's pretty noisy, but it is definitely something you should look at.